All right, welcome back to the Money Master Podcast. I'm Nick Davis, and this is a unique podcast today because normally we talk about a topic that we've pre-planned, and it's usually just me, Connie, and Tori. But today we have with us a special guest, and today we have Derek Prusa, who's a chartered financial analyst, a CFA and a CFP. We flew him in from Grand Rapids, Michigan, because tonight he's going to be talking to at our client event, and so. Let's get ready to find out today, how does he feel about investing, he's actually here to talk about 2023 and maybe even how we feel about when people say what to expect about 2024, and even talk about his own private practice and how he helps retirees through investment as well.
This is the Money Master Podcast from Brindle and Bay Wealth Management, with Tori Tenhagen, Connie Davis, and certified financial planner Nick Davis.
All right, welcome back. It's Nick here, Connie, and welcome Derek.
Hey, thanks Nick. Thanks for having me.
Just got you off the plane a few hours ago.
Glad you're here.
I'm glad to be here.
I heard you say this is more sunshine that you've seen in a few minutes, more than 2 weeks, right?
Yes, yeah. It's been a little bit of snow that we've been getting up in Michigan, so it's nice to see the sun peeking out from the clouds, but have to get used to it. Don't want to get sunburned down here.
Well, it's like 70 degrees today is the high, and you just came from the snow?
Yes, yeah. Snow's starting to melt a little bit, but mid-30s and cloudy is what we're going to be seeing for the next couple of months. So.
Oh my gosh.
Yeah. So he's here for just one day, speaking tonight at our event, and he has to go. I thought we probably should have kept him here a few more days to be able to enjoy the sun before he goes back. So with Derek, our history, I've known Derek for as long as I've been in financial planning. So just as an introduction, he's on our investment committee for Brindle and Bay. And prior to this, he was actually one of the key CFAs actually at a Inc. 500. We call him a TAMP, but it's more of an investment portfolio group that helps financial advisors. So he was speaking to thousands of financial advisors on a monthly basis there, transitioned years later, and now he is the person who does our market video every month. So if you ever watch our market video, he is the person that's talking about what's going on there. And we were just talking, he's like 30 something now, but when he was in his 20s, he was under 30 for, what was that, Think Advisor, right?
Yes, yeah. Think Advisor, back before I had a few gray hairs starting to poke out. So
before you had a beard too.
Yes, when I was baby face, and I probably looked more 12 than in my 20s at that point. So,
hey, when we used to have a slide deck with Derek's picture on it, and when clients and prospects were in the office, we would always have to apologize. We'd say, listen, Derek's really, really smart. We think he's unofficially one of the youngest people. He's actually a part of the youngest people who ever became a CFA/CFP, like right out of school, because that's quite an achievement. And so, over the years, when you hear Derek speak, this guy knows what he's talking about. He's got a private practice in Grand Rapids, Michigan. We lean on him heavily in terms of certain tasks that we have to do at times. And so I'm just really glad you're here.
Yeah, I appreciate it. Thanks for the kind words.
I'm sure there's some other accolades I could throw in there too, but I don't have any notes. We're just visiting right after the plane here, and we thought it'd be good to let's capture you right off the plane and talk about his practice is a lot to people who are getting close to retirement, right? Would you say it's like within 10 or 15 years of the time they retire?
Correct. Yeah, probably about 10 years or so, going into the early retirement years as well as most of the folks that we see.
Okay. And I know, Connie, you had some questions about you wanted to ask him about.
Yeah, I just have some fun questions. So chartered financial analyst, CFA for short, right?
Yes.
It's very common. People have heard of it before, but for people who maybe haven't heard of it, how would you describe a chartered financial analyst? Like if you had to describe it super simply to maybe a middle schooler, how would you describe it?
For sure. So I think CFA, like you mentioned, it's going to be more common, especially in the investment industry. But I think a lot of folks that maybe aren't in the industry maybe aren't as familiar with it as the CFP, for example. So the way that I kind of like to commonly look at that is saying, okay, the CFP is a really broad base of knowledge. You're going to have a lot of different information in different areas like estate planning, investment management, tax planning, insurance planning, things of that nature. Whereas a CFA is going to be really more concentrated, narrowly on investment and portfolio management specifically. So how to value companies, find different investment opportunities, what are good investment portfolio management techniques and practices. So really just sort of taking all of that investment knowledge and going a mile deep and a foot wide versus a mile wide and a foot deep.
Oh, that makes sense. That's a good way to
You gotta know more math to be a CFA.
Yes, yeah, probably a little bit more nerdy than the CFP, if that's even possible. But
so I assume then you've always enjoyed math, even as a young kid.
Yes, definitely. So I know math was always sort of my stronger subject in school. Maybe didn't apply myself as much as I should have in other areas of my academic career early on, but math I've always seemed to gravitate towards that, even to the extent where when I was going through my science classes, I just tended to flourish more in physics, being more of a math-based sort of science category. And then once I got to college and sort of found the more specific niche of investments and finance, I really started to just hone in on that and really sort of dove into it with both feet, because math has just always been sort of a passion and something that's really clicked from being younger.
Yeah.
Well, I can say I appreciate people who really are good and enjoy math, because I don't at all. So we need people like you.
Yes.
Right?
Well, even people who are retired or getting near retirement, they've been great with very intelligent people. They don't, they want to know they got good people on their team. Like they don't want to have to know that stuff all the time. I'm surprised at how many times I get in the weeds with our clients trying to talk about things, and they don't really care, even though they're sophisticated people. They're like, listen, I mean, I was on the phone with somebody recently explaining actually some of how our models work, which, Derek has a lot to do with that. And he said, I trust you. I don't care. I've read all your stuff. Like, do what you think makes sense,
Absolutely.
And it's crazy because at some point that same person is a very intelligent person, does all their due diligence, all the research, but there's a certain point where you have to kind of say, okay, I know who I'm working with. Right. And a lot of what we're talking about is investing for retirement. And I think people get more nervous about investing, getting closer to retirement and through retirement. Like that's a big challenge.
Absolutely. Yeah, it's a total mindset shift where when you are working and have a number of years ahead of you and you're still accumulating into your portfolio, if you make a misstep, you know that you have time to recover from that. But all of a sudden you have to realize that your time horizon is being shortened, and maybe you have to be a little bit more intentional with the moves that you're making to be prepared for going into retirement and living off of your portfolio rather than adding to it.
Yeah. So you basically face both worlds. I mean, Derek, what he does is he's got a private practice where he helps retirees like we do at Brindle and Bay. But then he's also got a practice where he helps other financial planners in firms. And so that's part of the reason why he's here. So he and I are interacting on a regular basis all year round about various things. So with your private practice, you probably hear some of the same things we do, but what are some of the mistakes or investment concerns? Like, what are some of the biggest challenges that you see are happening for people getting close to retirement when they come to see you guys?
Yeah, I'd say one of the biggest mistakes that we find folks have is they really just don't have a definitive plan laid out in front of them. So maybe they've met with somebody and they've taken a risk tolerance questionnaire, or they've taken a risk tolerance questionnaire on their 401k provider and say, hey, I'm a moderate investor. Should I invest in this target date retirement fund? Or I'm going to be a 60-40, 60% stocks, 40% bonds sort of investor and allocate my accounts that way. But they don't necessarily have a plan for, okay, well, I have different account types with different tax purposes and different goals behind them. And should they be invested all the same? Should I invest them differently? What tool should I be investing in? There's so many different investment options out there now that there's no one size fits all answer. So we have to, get a little bit more intentional with how exactly are we setting that up for when we get into those later years in our life, rather than just sort of saying, hey, we're going to invest in a moderate risk portfolio and that's good enough. I think that's one of the biggest mistakes that we'll find for sure.
Yeah, this is good enough. We're going to be in a moderate portfolio, but we're not taking into consideration the tax status of the account. We're not taking into consideration we own some of the same holdings in this account that we own in the other accounts. How do those interact with each other? And maybe even we have more than one advisor. We have like a 401k advisor, and we have some stuff we're doing on the side. How is all that interacting, right? There's just a whole bunch of stuff. So how do you typically just take them through the process of straightening them out? Like what kind of advice do you give them?
Yeah, so really kind of to your point, we just try to get a more holistic view of what account types do they have, how much assets are in each type of account, what are their goals and their needs in the future, how do they all interact together, making sure there's not too much overlap, but that we're not, getting too far out of whack with their general risk tolerance as well. So really just try to dive deeper, figure out a plan, and then also making sure that we have a plan that's fluid and flexible as well, because as we all know, the world changes. We change as people as well. Nobody is the same today as they were 2 years ago, 5 years ago, 10 years ago. So as we grow, as we mature, and as we go throughout our retirement journey, our needs and how we see that playing out tends to change. And then again, just look at the world 20, 30 years ago compared to today. I don't think anybody could have predicted the types of advancements that we've seen and where we are, as a human species at this point. So really we just try to figure out, okay, how do we set up a plan, but then also make sure that we have pieces in place that are going to help monitor that along the way and make adjustments based on changing market conditions and changing personal conditions as well.
Are you ready to take the next step in creating your own next chapter? Are you looking for calmness and clarity around your retirement future? We'd love to visit with you about that. It all starts with a 15-minute phone call, and you can get that set up on your phone or computer right now by going to brindleandbay.com, which is our website, and you would click on the button that says Let's Talk. Again, go to brindleandbay.com, click on the Let's Talk button, and let's get the conversation started. When you say, that it's flexible, though, there's something that makes me cringe, right? Because a lot of people, there's actually things that people can say that you're like, as a financial planner, you hear that and you're like, oh, they have such the wrong mindset, right? Because when you say flexible, they automatically default to there's an election coming up, so we should do something because of the election.
Yes.
Right. So how do you distinguish that?
Yeah. So kind of what you're talking about is a lot of folks might try to time the markets essentially, and they might be looking at different events or different things and try to predict what's going to happen in the markets. How is that going to impact my portfolio? Should I make some adjustments ahead of time? And really, there's no perfect way to time the exact tops and bottoms. So we want to make sure that we're being flexible more from a standpoint of what are our goals? How are our lifestyles changing? What sort of needs do we have? And are there ways that we could maybe tilt one way or the other to a small extent to be able to take advantage of market inefficiencies, but not necessarily making all or nothing calls? Because that is one common mistake that we'll find with folks as well is, hey, I have to be all in or all out, and there's nowhere in between.
That's a cringe point.
Absolutely, yes. And when it works great, but unfortunately nothing works 100% of the time in the markets. And so what we'll find oftentimes is folks maybe get it right once or twice, and then they start to get a little bit overconfident, and then that's when their portfolio can blow up because they start to make too big of bets in one direction or the other, and then when it goes the wrong way, that's when they see their pain points come to life.
Nothing makes me more angry, actually, than there's actual firms that believe in getting out of the market, and moving to cash. And they've built their entire practice around that. That's their entire messaging.
Yes.
It's just there's so many things wrong with that, right? So like what I hear you saying, and I know this to be true because obviously we work together, but is that you said when life changes or your goal changes, then there's some adjustments maybe that happens. If your goals change, which that it doesn't happen very often once you got a plan in place, right?
Correct.
So that's the thing, right? In general, there's a lot of consistency that happens. Now I know that another question, this is kind of a loaded question, but active versus passive, right? Should they be actively traded or passive? And there's just, it's like saying, let's talk about God, right? Like what's your flavor of how you want to interpret God? Because it could go, there's a lot of people who have different opinions about that, right? But I think we agree that for the most part, passive is really good, well diversified. However, in some cases, there's some theory that could work in terms of slightly active, right? And it's not predictive; it's actually reactive. Would you say that's true? I mean, you're actually reacting rather than trying to predict in a lot of these active types of models. So, to kind of put it straight, what do you think? Passive versus or active or both?
Yeah, so I would say I'd have to lean both in that scenario. So passive, again, studies show that over time you can let markets do the heavy lifting. If you have a long enough of a time period ahead of you, markets, they tend to go up and to the right. So eventually the markets are going to grow and expand. And if we don't believe that, then we shouldn't be investing our assets anyways, because that's a totally different story. Maybe we're better off raising chickens and living on a farm. You know,
if we don't believe that, then we shouldn't be in the market. If we don't believe it goes up and to the right.
Correct. Yeah. Exactly. So in that sense, passive is a very easy, simple way to gain that sort of exposure, where we know that over a long enough of a period, maybe there's going to be some market corrections or bear marks along the way, but 5, 10, 15, 20 years in the future, our portfolio should be larger than it is right now.
Right.
But also, if we're using a slightly active approach, I would say, again, we don't want to make all or nothing calls, but if we can make adjustments to market conditions, then that could potentially give us some good opportunity to take advantage of market trends as well, without getting too far over our skis, or without trying to take too much of a stance one way or the other. So I think a good example of that would be, if you look at academic and historical studies, they'll show value investing tends to outperform growth investing. So if you have like a blue chip dividend paying value stock, the return is over the long run going to be higher than if you have a growth oriented stock like a tech company, for example. But what we're seeing over the past 10 plus years at this point is that growth has significantly outpaced value, and the pendulum swings one way or the other. So at some point, we would expect that value would come into more favor, but also when is that going to happen? What's going to be the catalyst behind that? So from a behavioral standpoint, I think an active piece to the portfolio, maybe let a passive piece do some of the heavy lifting, let your portfolio go up and to the right with the markets, but then having a piece that can make those adjustments, so maybe be overweight growth over value in a scenario like we've seen the past 10 years, can help kind of scratch that itch too, to say, hey, I want to take advantage of these trends, but don't want to do too much to my portfolio to maybe put myself in a bad position if those trends were to reverse quickly as well.
And the trends are not of the month or of even the 6-month period. These are bigger period trends. So again, people think day trading is the thing, and it's not, right? I like what you said about value versus growth as an example, because correct me if I'm wrong, but value investing has a larger expected return. However, there's a 10-year period where large cap growth, not value, did better, a lot better. But if you contrast that to the 10 years before that, there was a period where value saved the day, right? So that's what you're talking about, these much longer term type of trends.
Yeah, the markets tend to work in different regimes. So if you're looking at the dot-com bubble, value significantly outperformed growth over that period as those sort of high-flying tech companies that crushed. Coming out of the 2008 financial crisis, growth was able to outpace value, really largely because interest rates were kept historically low for such a long period of time that they were able to leverage their growth and essentially take on debt that maybe they otherwise couldn't have in previous regimes before that. But if you look at history, again, value has tended to outpace growth over the long term and over, say the last 100 or so years of stock market history. But there's still been periods where growth, maybe for 2, 3, 4, 5, 6, 7 years, is going to be able to outpace value as well. So again, being able to latch onto those longer term trends, like you said, you're not going to want to make these overhauling adjustments on a daily or weekly or monthly basis. But if you're able to sort of ebb and flow with the markets, you're going to maybe be able to pick up on some of those and complement a more passive strategy as well.
Yeah. So to answer the question, passive versus active, he said both. But in general, kind of our practices, and a lot of this has come over the years, especially with your tutelage on this, is non-qualified accounts are mostly passive because there's tax implications there, but some activity in the qualified accounts where the taxes aren't as much of an issue, right? And not day trading and not getting out of the market for elections. Now, I have a question though. This is going to be a little bit of a loaded question, but this is a question that I think has been on my mind a lot. And it's about, should people have stocks, in stock market as they go into retirement and through retirement. And, when you go to financial planning school, so the way I like to call it, instead of like getting overly technical, traditionally it was like these target date funds. Your goal is to basically, as you get older, own more bonds. And everybody is programmed to think that. They all come in, to their financial advisor, broker, I'm getting older, I'm getting close to retirement, I can't take as much risk. And so, it made sense that as you get older, you buy more bonds. But, these schools of thought in academics are teaching that we have longer time horizons now, and inflation's a real deal. So we really have to hold, it actually makes more sense to say protect the front end of retirement and then own more equities as we get older. That makes a lot of sense. But it's really hard, right, as we get closer to convince near retirees or retirees that they have to have a healthy amount of equities. So the question is should people have these equities? Like, what are your thoughts about owning stocks as you get close to retirement and in retirement, and basically some of the studies that I've just mentioned?
Yeah, I think it definitely makes sense to own equities throughout retirement, and even maybe to a larger extent than most folks would find with conventional knowledge. And I think with a lot of those studies that you've kind of referenced too, and we're thinking about just general rules of thumb when it comes to investing, with you can take X% of your portfolio per year and you won't run out of money, or whatever the thought process might be. A lot of those were sort of created in a time when bond rates were significantly higher than they are now. So one of the biggest determinants of what a bond portfolio is going to do in the future is where current interest rates are right now. And even with the recent Fed rate hikes, we're still in a relatively historically low bond rate environment. And then in addition to that, if folks are worried about inflation risks in retirement, one of the best long-term hedges to inflation is to own equities or stocks. Kind of inherently, if you think that inflation's a risk and that prices are going higher, it's because companies are charging us more for the goods and services that they offer, which means that their earnings are going to go up, which will inherently make the value of those companies go up over the long term. Doesn't always hold true in the very short term, just like anything else in the markets. There's no sure thing. There's no 100% bet to hedge against inflation, but history does show us that over a long period of time, stocks are one of the best inflation hedges when it comes to markets.
People always think gold is the better hedge, and it's just irritating because that's just not, it's so not true. It's a great monetary hedge, but it's not, when it comes to stocks. We always tell people dividends outpaced inflation like 3-1 during your lifetime.
Yes, exactly. Absolutely.
And inflation, I think we're feeling it more now than ever before because, somebody just commented on our YouTube channel recently. They said, I retired in Florida, but I'm watching people suffer because the real inflation is more impactful than what you say 3%, 5%, 9% last year, whatever. In reality, it's just way more impactful when you have to be able to maintain your lifestyle. And I guess the real challenge is keeping people with the right perspective of owning what we call the great American companies. People who go to work every day trying to capture human ingenuity. They're solving the problems. And I was telling somebody the other day, as we get older and we're not, I'm only 46 and I feel like I can't keep up with technology. So I can't imagine as I get older, how I feel like how hard it would be to keep up with everything that's always changing. Well, one thing that's always going to keep up is those millions of employees that go to work, for those CEOs that are after profits and earnings, and they're capturing and they're capturing that human ingenuity, and they're solving those problems. They're going to figure out what to do with AI. Our job is just to not get stuck in a bubble, right? To not get stuck with the next .com or the next great thing that's not going to be so great, right? So that's why you got to be well diversified, and I think it's smarter to be into many of these companies than it is to do just about anything else with our money. So in general, as you get people closer to retirement and you're kind of taking them through your practice, have you seen that are people able to kind of calm down about, how they feel about the stock market? Do you have any tricks that you kind of tell them to make them kind of grasp it differently?
I think one of the best tricks is just telling them not to watch the news, and to turn off the talking heads. So I know kind of our thought process is that when you're tuning into whatever channel you're watching or getting your data from whatever feed, they're not really speaking to your specific situation. So we really have to sort of drown out the noise as much as possible, which in this day and age is really difficult with how much technology and how much in your face things you're getting pinged on your phone every time that there's a market update,
yes,
or the Fed hikes rates or doesn't hike rates, or whatever it might be, and really just sort of try to slow down and say, okay, well, what does this mean to me? How does this impact my long-term path, or does it even impact my long-term path? And kind of like your point too about diversification earlier is that, again, if we're just going to be chasing returns of, hey, NVIDIA's had a great run, let's go ahead and dump all our money in there, why wouldn't you? Well, the risk is that if all of a sudden AI doesn't play out the way that everyone thinks that it might, then there's a huge risk that it could come back down to earth. So diversification and sort of planning in general is, in my mind, a form of regret minimization. So we aren't necessarily ever going to be at the top of the list in performance, but we're also never going to be at the bottom either. So the thought is, can we have a smoother return? Just make sure that we're making intelligent decisions, taking emotions out of it. We don't want to let the market movements or, somebody or our neighbors talking about a hot investment or the news telling us that Tesla or Apple or Bitcoin could be good or bad. At the end of the day, what are we looking to accomplish, and what decisions can we make in an intelligent, sort of methodical manner to most efficiently reach our goals with the least amount of risk or least amount of regret possible?
Yeah. So like NVIDIA, one stock is speculation, right? Yep. But owning multiple stocks in a systematic way is investing. And to me, there's a huge difference between speculating and investing. And I think the more you get along, if you get burned enough times, I think that Robinhood and everything is making it possible for people to get burned pretty quickly with the amount of trades that people make, to where you eventually hopefully go back and realize, oh, that 80-20 portfolio I had, or that 60-40 was actually pretty good.
Yeah, I think that's probably one of the best things about those apps is they allow more folks than ever in history to be able to access the ability to test out their own ideas, but generally at a younger age and with a lower amount of capital outlay. So hopefully you can learn those lessons early on, and as you get a little bit older and have more assets to grow for the long term, you're not making those decisions when you get to that point.
Right. What you said about the media is so true, because almost everything the media says, there's always a different side of the story. And a lot of times for those people who read our newsletter, Nick's memo that comes out on Fridays, a lot of times we'll explain, like, here's some perspective. Like we do one that's on charts, and it's like, here's, the media said this, but, they talk about unemployment being really bad, but look at spending is up, right? And how does this offset that? And the economy is not necessarily connected to exactly what happens in the stock market all the time, and getting a different perspective. I mean, here, the people who really do the trades, the people who really do run the funds of the world, they're not watching the media. Like they're using information that's more that you find like in those newsletters. I wanted to ask you this too, Derek. We hear things that make us cringe, or make us want to say, "Oh, you're believing that so wrong," And I just gave an example. Maybe you can think of one, but there was one. This one I hear a lot, and I actually just heard it literally yesterday. The person said, "Yeah, in this account," they said, "I'm really happy with your accounts. I'm really happy with it. And before this account that I usually always get 6 to 8% per year. Before I came to you guys." And I just cringed when I heard that, because I thought, man, let me show you a chart of 110 years, and how many times the average is. Let's just say the average is 8%, and let's look at how many times anywhere between 6 and 8% even happened during those 110 years. The answer is 6 to 7 times. So you're going to get a 14, you're going to get a 3, you're going to get a -5. All that equals what you say is what you're targeting long term, right? That tells us we can't judge things on 6 months or 1 year, and we can't say that account normally gets 6 to 8%. Well, in relationship to what, right? Like this year, it should have gotten a lot more than that, right? And last year, it would have done very dismal, right? So are you saying you always get 6 to 8%? So that I had to kind of pull out that chart and just help them, and they immediately said, "Yeah, you're right. I definitely don't always see that. That I got to accept that 13% or accept that 2%." Anything come to your mind that's kind of like you hear people say you just immediately want to correct?
Yeah, there's two main ones that I can think of. So the first one is just, hey, the markets are up 25% this year. Why is my account up X%? And I think a lot of that does come from, just, again, watching the news. They're going to talk about the S&P 500. People refer to the S&P 500 as the market per se. And at the end of the day, the S&P, while it is a large cap representing the largest companies within the U.S. economy, first of all, it's only 500 companies within the entire U.S. economy, which is made up of thousands of companies. And then the U.S. is only a portion of the entire world. So when we're talking about the markets and what should we be benchmarking our portfolio to, again, I think a lot of times it comes back to, well, we shouldn't necessarily be trying to keep up with the S&P 500 in good years. we should be trying to make sure that we have an intelligently diversified portfolio that is set up appropriately for our goals. And some years it could do better than the S&P. Some years maybe worse. Lately, it has been doing better because the S&P is being dominated by those larger tech companies.
Yeah.
But that's not always going to be the case. And so, again, just kind of talking about markets, it's a much broader conversation than just the S&P 500.
And it's not an easy answer. It's not an easy answer to say, oh, you don't. You literally have to understand, that you're looking at all large cap, and you have to maybe even consider other technical things like standard deviation and correlation, and these are things that the media doesn't cover very well, and that's what makes it so deceptive for for the investor, right?
Exactly.
So,
yeah, and I think the other one that kind of comes to top of mind is folks, especially when it comes to 401ks versus maybe an IRA that they're managing outside of their 401ks. Hey, my 401k account always goes up. Why is my IRA account not going up? It's like, well, I think a lot of folks, maybe they aren't remembering or realizing that they're contributing to their 401k on a regular basis.
Yeah.
So even when markets come down, because data shows that 95% of the time, the S&P, so again, just so I don't like using S&P as a market, but I'm going to use it for this example. So, talking about both sides of my mouth here. But the data shows that the S&P 500 is actually underwater below fresh all-time highs 95% of the time, meaning that it only truly sets a new high 5% of trading days. And so when we're saying, hey, this account should always be up or this account always grows, very much on the same note like you were mentioning, that's not quite the case. Markets tend to reach new highs in spurts and then spend some time underwater and then reach some new highs in spurts again. So I think just understanding that, there can be some differences in accounts and what they're set up for and why we're seeing the returns that we're seeing.
Yeah. Yeah.
I would like to say, just for me sitting here listening to you guys have this conversation, I appreciate the level-headedness of the conversation, and the perspective that you both bring to the table as being a CFP and meeting with people who are near retirement every day. And I would say that your clients, of each of you, would appreciate the level-headedness and the perspective. And when you're watching the news headlines and you're starting to freak out, like, oh my gosh, what are we going to do? They can send you an email or give you a phone call and you're like, okay, let's put this into perspective. And then they're like, oh, okay, thank you. I feel so much better. So I that's what I was appreciating about the conversation here.
Well, I always appreciate getting to talk to Derek and this is the first time you've been in Texas and with us. I mean, you've been in Texas a few times, but not here for this event tonight. So it'll be really great.
I would just say before you finish, I have a wrap-up question. This is just a fun question.
Go for it.
As we close up here. So is there a book that you would recommend, like one of your favorite books that made an impact in your life, or maybe a recent book that you're reading that you really appreciate?
Yeah, so funny enough that you're saying that, I'm actually looking over Connie's shoulder right now because I mentioned to Nick, I want to make sure I get the title right. It's The Psychology of Money by Morgan Housel. I was actually reading it on the plane ride in, and I've been reading it, trying to take some notes on each of the chapters, and I think it's really just sort of expanded my understanding of how important the behavioral side of investing is relative to just the dollars and cents and what you see on the statement. A lot of how we invest our money is how we feel about it as well, and that can really impact the decisions that we make. And everybody comes from a different situation and comes from a different walk of life, and kind of where you sit is where you stand. So we want to make sure that we're taking that in consideration as well. So really just trying to understand how we think about money and how that can impact investment decisions to help us become even more efficient with how we make recommendations as advisors, I think. So
that's funny that you mentioned that book. We're actually reading the same book and getting ready to do a podcast on the book.
We're going to do a book club podcast on the psychology of money. Yeah. And we're going to actually record it today. So since Derek's here, maybe we'll have him hop in with us.
Yeah.
We're going to see how it goes. It's a fantastic book, Psychology of Money.
Well, great. Yeah. Well, thank you for joining us today. We really appreciate that. And thank you, everyone, for listening in. We absolutely appreciate you. We'd love to hear your feedback. Send us your comments, your questions, and share the episode with people that you like. Talk to you soon.
Hey, it's Nick here. I know that many of our listeners like to read books about financial planning, and I wrote a book called A Wealth of Wisdom, and in it I share a story about my grandpa and his successful retirement. I also point out that his world, he retired in the 1990s, his world was very different from today's retiree. There are certain things that today's retiree must do to be successful in retirement. So there's no cost for the book. All you have to do is text us the word book to our office line, and I'll get that sent over to you right away. The number is 214-988-9178. Again, you'll text the word book to 214-988-9178.
Nick Davis is an investment advisor representative of Brindle and Bay Financial Advisors, a registered investment advisor. This show is for informational purposes only. Any exposure to ideas and financial vehicles discussed should not be considered financial advice or a recommendation to buy or sell a financial vehicle. You should consult a qualified financial, tax, or legal professional before taking any action. This program is not endorsed by the Social Security Administration or any other government agency. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing company. Insurance licensed in Texas, number 1188639. Brindle and Bay Wealth Management is affiliated with Brindle and Bay Financial Advisors.